Well, Future is pairing earlier losses after President Trump signaled a 100% tariff on China was not sustainable. During Thursday's sell-off, the 10-year yield hit the closely watched 4% level, and the VIX reaching its highest level since April's Liberation Day tariffs were announced. Joining us now is Liz Ann Saunders, Charles Schwab Chief Investment Strategist. And Liz Ann, there's so many nuances within this market, and even just today, all the whipsaw that we've seen with these headlines. I guess, what do you make of what we saw earlier, the sell-off with the regionals, private credit stress, and then recovering a bit off of those more optimistic comments from President Trump?
What I think is interesting about what's happened with the regional banks and these recent mishaps is it further highlights the bifurcations that exist more broadly in the economy. So when you think about the fact that the Zion's news, the Western Alliance news came right as we were getting reports from the larger banks in the beginning of earnings season. And given that the larger banks, their borrowers tend to be much higher in quality, higher in income. So you see these bifurcations, and it reflects kind of the K-shaped nature of the economy. You see it in inflation data, you see it in consumption data, and it has translated into market behavior too. There's just sort of the group of haves and the group of have-nots.
Right, the bifurcation of the consumer and then the bifurcation within the actual stock market. And we'll talk about tech in just a second. But when you look at what's going on with the regionals, and to borrow Jamie Dimon's quote, a few cockroaches means there likely are more. How do you separate what's idiosyncratic or more systemic by nature? Are there certain clues or signals that you look at that would maybe spook you a bit more? Well,
to measure whether it's spreading sort of up the size spectrum, listen to the larger companies. Analysts undoubtedly will be peppering the companies they cover with a lot of these questions. Look at broad measures of credit spreads, which have not blown out. So I think there are metrics to watch filtering into the equity market, continued move higher in the volatility index. But I think that we're probably in a somewhat similar situation to the early part of 2023 when we had the mini banking crisis. And you did have a period where it was an infection more broadly in the market and in the larger financials, but ultimately things settled down, and in fact it triggered some consolidation. And it wouldn't surprise me to see some of that consolidation.
So shades of the SVB collapse, potentially?
Hopefully nowhere near as serious, but it reflects the lower sort of quality nature of many of the borrowers down the regional into the regional banks, and the fact that we're somewhat late in the lending cycle and you're starting to maybe get a sense of a little bit less proper due diligence, which is, I think, part of this story. And I think it sort of puts the larger financials in a position to really make sure that due diligence is up to snuff.
Yeah, interesting. And I'm sure the Fed, which meets next week, they'll probably get some questions about this as well, potentially.
No question.
And when we look across the stock market, I mentioned tech. And we've been hearing, is this a bubble? Are we priced to perfection? We've seen this circular investment cycle among all the major banks. Where do you sit with tech right now? Are you optimistic?
So if we think about AI-specific tech, so let's use the Magnificent Seven instead of just picking on tech, because it's a pretty diverse sector. The one thing, it's not an imminent concern, but maybe something that bears watching. So Mag 7 as a share of overall S&P 500 CapEx is about a third. So that's a pretty high percentage of CapEx driven by just a small handful of companies. Free cash flow growth for the Mag 7 has gone from more than 60% positive 5 quarters ago now into slight negative territory. This boom, I think the word bubble tends to get thrown around too much. This boom has been largely an equity financed boom. It's come out of cash flows. Now that free cash flow growth has decelerated into slight negative territory, and you're starting to see more deals that get done with debt. It's just kind of a back of mind thing to focus on. The maybe good news is there's less speculative fervor in those mega cap dominant names. The recent kind of hype cycle has gone into more esoteric, micro, small levels, like at the basket level, quantum and drones and the meme stocks. And those have come off the boil a little bit in the last several trading days. But that's where speculation that is very AI driven is now more concentrated in these kind of tiny little pockets, as opposed to in the mega cap names that had been all the rage in the last couple of years.
And that's super interesting to me, because people have told me that this is why this is different than the dot-com boom, because you have companies with really strong cash flows and balance sheets. And you were just talking about how we're seeing more of this debt financing. I guess at what point do you think we're going to start to see more of that? Is that only certain companies that are financing with debt?
Those that have seen a decline in their free cash flow yields, that they can't finance it out of cash flows. I would say one of the keys here is there's a decelerating rate of earnings growth, but to your point, there's more there than was the case in the late 1990s. They're really, the high flyers actually had no denominator in the PE equation. So it was purely a price bubble. I think what we need to be more mindful of now is the earnings side, and a point where maybe the expectations bar has gotten set a bit too high. And you could have one or two high profile misses, even if in level terms, the growth rates are still strong. It's, I've been doing this for almost 40 years, and one of my favorite things to say about the market, and as it relates to things like trends in earnings or trends in economic data, better or worse tends to matter more than good or bad. Okay. It's human nature for us to think that's still a really strong growth rate, but if it's a decelerating pace, that's something to be mindful. In the meantime, you've got an accelerating pace of earnings in an index like the Russell 2000. I would say avoid the lower quality, no earnings part of that index, however.
Right, and as we get into the thick of earnings season, that's going to be critical. And real quickly here, given the losses that we're seeing today, if you step back, is this a time to buy the dip? Do you maybe want to get a little bit more defensive heading into your end?
Depends on who the investor is. I think all or nothing, or get out, picking a moment in time, that's not investing. That's just gambling on moments in time. Investing should be a disciplined process over time. So dollar cost averaging tends to be a great discipline. So is rebalancing. Rebalancing is a great discipline because you're adding to where there's been underperformance, but you're also trimming in areas where there's been outperformance. It's not discussed all that much. Maybe it's a boring topic on FinTV.
Yeah, no, I love it. Let's talk rebalancing.
Rebalancing is a great discipline.
All right, awesome. Well, Lizanne Saunders, thank you so much for coming in. What a day, and especially in studio. Appreciate it. Well, Future is pairing earlier losses after President Trump signaled a 100% tariff on China was not sustainable. During Thursday's sell-off, the 10-year yield hit the closely watched 4% level, and the VIX reaching its highest level since April's Liberation Day tariffs were announced. Joining us now is Lizanne Saunders, Charles Schwab Chief Investment Strategist. And Lizanne, there's so many nuances within this market, and even just today, all the whipsaw that we've seen with these headlines. I guess, what do you make of what we saw earlier, the sell-off with the regionals, private credit stress, and then recovering a bit off of those more optimistic comments from President Trump?
What I think is interesting about what's happened with the regional banks and these recent mishaps is it further highlights the bifurcations that exist more broadly in the economy. So when you think about the fact that the Zion's news, the Western Alliance news came right as we were getting reports from the larger banks in the beginning of earnings season. And given that the larger banks, their borrowers tend to be much higher in quality, higher in income. So you see these bifurcations, and it reflects kind of the K-shaped nature of the economy. You see it in inflation data, you see it in consumption data, and it has translated into market behavior too. There's just sort of the group of haves and the group of have-nots.
Right, the bifurcation of the consumer and then the bifurcation within the actual stock market. And we'll talk about tech in just a second. But when you look at what's going on with the regionals, and to borrow Jamie Dimon's quote, a few cockroaches means there likely are more. How do you separate what's idiosyncratic or more systemic by nature? Are there certain clues or signals that you look at that would maybe spook you a bit more?
Well, to measure whether it's spreading sort of up the size spectrum, listen to the larger companies. Analysts undoubtedly will be peppering the companies they cover with a lot of these questions. Look at broad measures of credit spreads, which have not blown out. So I think there are metrics to watch filtering into the equity market, continued move higher in the volatility index. But I think that we're probably in a somewhat similar situation to the early part of 2023 when we had the mini banking crisis. And you did have a period where it was an infection more broadly in the market and in the larger financials, but ultimately things settled down, and in fact it triggered some consolidation. And it wouldn't surprise me to see some of that consolidation.
So shades of the SVB collapse potentially?
Hopefully nowhere near as serious, but it reflects the lower sort of quality nature of many of the borrowers down the regional into the regional banks, and the fact that we're somewhat late in the lending cycle and you're starting to maybe get a sense of a little bit less proper due diligence, which is, I think, part of this story. And I think it sort of puts the larger financials in a position to really make sure that due diligence is up to snuff.
Yeah, interesting. And I'm sure the Fed, which meets next week, they'll probably get some questions about this as well, potentially.
No question.
And when we look across the stock market, I mentioned tech. And we've been hearing, is this a bubble? Are we priced to perfection? We've seen this circular investment cycle among all the major banks. Where do you sit with tech right now? Are you optimistic?
So if we think about AI-specific tech, so let's use the Magnificent Seven instead of just picking on tech, because it's a pretty diverse sector. The one thing, it's not an imminent concern, but maybe something that bears watching. So Mag 7 as a share of overall S&P 500 CapEx is about a third. So that's a pretty high percentage of CapEx driven by just a small handful of companies. Free cash flow growth for the Mag 7 has gone from more than 60% positive 5 quarters ago now into slight negative territory. This boom, I think the word bubble tends to get thrown around too much. This boom has been largely an equity financed boom. It's come out of cash flows. Now that free cash flow growth has decelerated into slight negative territory, and you're starting to see more deals that get done with debt. It's just kind of a back of mind thing to focus on. The maybe good news is there's less speculative fervor in those mega cap dominant names. The recent kind of hype cycle has gone into more esoteric, micro, small levels, like at the basket level, quantum and drones and the meme stocks. And those have come off the boil a little bit in the last several trading days. But that's where speculation that is very AI driven is now more concentrated in these kind of tiny little pockets, as opposed to in the mega cap names that had been all the rage in the last couple of years.
And that's super interesting to me, because people have told me that this is why this is different than the dot-com boom, because you have companies with really strong cash flows and balance sheets. And you were just talking about how we're seeing more of this debt financing. I guess at what point do you think we're going to start to see more of that? Is that only certain companies that are financing with debt?
Those that have seen a decline in their free cash flow yields, that they can't finance it out of cash flows. I would say one of the keys here is there's a decelerating rate of earnings growth, but to your point, there's more there than was the case in the late 1990s. They're really, the high flyers actually had no denominator in the PE equation. So it was purely a price bubble. I think what we need to be more mindful of now is the earnings side, and a point where maybe the expectations bar has gotten set a bit too high. And you could have 1 or 2 high profile misses, even if in level terms, the growth rates are still strong. It's, I've been doing this for almost 40 years, and one of my favorite things to say about the market, and as it relates to things like trends in earnings or trends in economic data, better or worse tends to matter more than good or bad.
Okay.
It's human nature for us to think that's still a really strong growth rate, but if it's a decelerating pace, that's something to be mindful. In the meantime, you've got an accelerating pace of earnings in an index like the Russell 2000. I would say avoid the lower quality, no earnings part of that index, however.
Right, and as we get into the thick of earnings season, that's going to be critical. And real quickly here, given the losses that we're seeing today, if you step back, is this a time to buy the dip? Do you maybe want to get a little bit more defensive heading into year-end?
Depends on who the investor is. I think all or nothing or get out, picking a moment in time, that's not investing. That's just gambling on moments in time. Investing should be a disciplined process over time. So dollar cost averaging tends to be a great discipline. So is rebalancing. Rebalancing is a great discipline because you're adding to where there's been underperformance, but you're also trimming in areas where there's been outperformance. It's not discussed all that much. Maybe it's a boring topic on FinTV.
Yeah, no, I love it. Let's talk rebalancing.
Rebalancing is a great discipline.
All right, awesome. Well, Lizanne Saunders, thank you so much for coming in. What a day, and especially in studio. Appreciate it.
We've had a bit of a roller coaster week on U.S.-China relations with the clear signs today that things are, at least from Trump's rhetoric perspective, on the upswing. We've seen Trump in a couple different forums today, including just about an hour ago at the White House, offering really kind of optimistic commentary about where things stand with China, at least for today. For one, this off again, on again meeting with President Xi Jinping of China and South Korea is now apparently on again. Trump said just a little bit ago, it looks like it's going forward. He also raised the possibility of some sort of agreement when the two leaders gather. They're set to talk on the sidelines of a summit in South Korea at the end of this month. Treasury Secretary Scott Bessent also announced today that there's going to be a kind of a series of talks leading up to that meeting. The first one is going to be actually this evening here in Washington on the sidelines of the IMF annual meetings. And then there'll be a follow-up next week at about a week's time in Malaysia. This is between Bessent and China's vice premier, so the two top trade officials there. Overall message here is things are looking good, and it comes a week to the day after Trump kind of surprise markets to the downside with this idea of a 100% tariff, an additional 100% tariff on China over rare earth minerals and supply chains that China is looking to restrict there. Worth noting that Trump didn't take this 100% tariff off the table today. He even discussed moving it up ahead of the November one that he's promised. But the overall message you're hearing from Trump and Bessent, for today at least, is that things are looking on the upside. The relationship between Trump and Xi, they're confident at least, can kind of bring the sides together and at least maintain the status quo for the time being.
And Ben, while we have you, we know Vladimir Zelensky in Washington today with President Trump. You know, after Ben Trump's remarks, Russian oil exports, India yesterday, what did we learn today?
Yeah, we learned a bit today. So this meeting, as you mentioned, was Trump with the Ukrainian president talking about the war in Ukraine, with oil clearly a big element of it. As Trump has talked about this week, Trump claims that India is going to stop its purchases of Russian oil, which would then pressure an end to the war. If that goes forward, it's a very significant economic lever to use against Vladimir Putin and Russia because of how reliant Russia is on oil revenues. Trump reiterated that claim today. He talked about how India, in his view, has already de-escalated, even as Indian officials aren't going quite that far. There is evidence that Indian suppliers are buying a bit less Russian oil, and that's going to continue. But there's no promises from that side, at least, of zeroing out. But this is clearly a lever here. Zelensky was also talking about oil, talking about meeting with energy companies for infrastructure projects going forward. So there's a real tie-up here between the energy diplomacy, the tariff diplomacy, all these kind of things intertwined, as Indian officials are also in Washington this week, just to make things even more complex, with at the IMF meetings to talk trade as well with the Trump administration. They're trying to get a 25% tariff over Russian oil lifted, and clearly both sides are trying to kind of find a middle ground there.
Treasury Secretary Scott Bessent saying Wednesday that there is a possibility of extending the tariff truce between the U.S. and China. The deadline before sweeping tariffs of over 100% additional go into effect is November 10th. While President Trump and Chinese President Xi are set to meet later this month, my next guest says a comprehensive trade deal Nowhere in sight. I want to bring in Shahzad Kazi, China Beige Book International Managing Director. Shahzad, good to see you as always.
See you.
So it doesn't, certainly it doesn't feel like, it feels like the two sides are getting further apart with this latest surge in rhetoric. Besant, in a press conference the other day, really coming out with some pretty strong words for the Chinese. What's going on here? What happened?
What happened over here fundamentally is, first of all, there was no real phase 2 process, even though there was a lot of optimism building in recent weeks. There's absolutely no march towards that deal that was taking place. Then, of course, you have commerce coming in and refining export control rules by putting in that 50% ownership rule, I guess I should say, and that really caught the Chinese by surprise. They were legitimately upset by that, and they respond, of course, very aggressively with their rare earths.
Remind me which export control rule this was, because it's hard to keep track of with the back and forth.
So fundamentally what this says is that if you are a Chinese entity that is not supposed to be receiving US-made chips, and you have a 50% ownership in another entity, that entity would also be blocked, right? So this was further fine-tuning and making sure that the export controls on the books actually make sense and are implemented in a sensible format. The Chinese saw this as a new action against them and were just incensed.
Now, the playbook that we have become accustomed to, the markets have been accustomed to, is both sides kind of go at each other. Usually the U.S. has been the aggressor, so to speak, with President Trump coming in with these dramatic pronouncements. Both sides sort of ratchet it up, and then you get that de-escalation. Are we still there? Is that, knowing what you do about the Chinese economy and how China operates, are we going to see that de-escalation this time?
I don't question that a de-escalation isn't possible. I think it's quite likely that, especially in the lead up to APEC, that you see both sides letting things cool off. But I think what we are from a longer term perspective over the next several years, I think we might just see a repeat of this over and over again, because either you just cannot bridge the gap between the two sides, which is what I firmly believe, and at the same time, you also don't have sort of this conversation taking place that we're going to decouple here and we're going to try to work together with each other here. So you're left with this mess that markets are constantly suffering as a result of.
Why don't you think we'll be able to bridge the gap? Because we both are, as you say, we're still not decoupled. We're pretty reliant on each other economically. And at least in theory, we should both be prospering together. It's in everyone's best interest for us to work together.
Well, I think the big problem is that from the Chinese perspective, that we finally come to a decision that says that we cannot just hand over all our latest technology to China. That's something they don't like. On the other hand, of course, we'd like China to rebalance its economy and not artificially keep prices low and dump its products abroad, which is not just a U.S. problem, but a global problem. And China will tell you all day long that they intend to not do so. But certainly that's been their economic model and continues to stay. I think those just right there are two of the biggest things keeping both parties in this conflict.
So what are the implications of all of this? So let's talk about the Chinese economy first. That's where you focus your attention. We did talk to a Wall Street veteran the other day who likes the Chinese market and who says, they're willing to put stimulus in no matter what happens with U.S. trade talks, and the economy's on solid footing. Do you agree?
The economy is actually doing much better than the perception has been. The summer slowdown narrative, I think, is rather misplaced. If anything, we've seen the Chinese economy post a recovery over the second quarter, into the third quarter, into the summer. Now, we'll see if that carries on into Q4, but certainly, parts looked stronger than what the market narrative had been.
And so what does that imply also for negotiations then?
I think it implies that you're looking at a Xi Jinping, you're looking at Beijing that are not panicking.
And so does that mean, between the U.S. and China, that I guess I'm just still trying to figure out how all of this plays out.
Yeah, I think, what you get is these series of mini truces taking place. I could even see the two sides working towards a very narrow phase 2 agreement. I think if the Chinese come to the table tomorrow and make pledges to start buying soybeans and agree to perhaps purchasing some Boeing airplanes and so forth, and roll back some of their more egregious export controls that they've rolled out, or clarify that they mean it, that civilian users will be fine, et cetera, I can see there being a phase 2, but the process to that will be, I think, incredibly messy, and I don't know how long that deal will last before the next blow up.
And in the short term, you mentioned APEC. That is the meeting, the Asian leaders meeting, where Xi and Trump had been set to meet. Then Trump said they weren't meeting. Besant says they're probably still meeting. Do they meet, and what does that What should we be watching for at that meeting?
I think from the Chinese perspective, they're going to not want to do anything very televised, getting the two presidents together in front of cameras. So from a public standpoint, we may not hear much. Do we just get a handshake? Do we get an understanding that says let the two sides continue working on resolving some of our issues? I think the Chinese side is not going to be wanting to get in front and having to see Trump making too many comments, even though the president may actually prefer that.
Our expectations should be low, in other words.
Absolutely, expectations should be very low on
And
this.
then finally, picking up on what we were talking about with the president saying India has agreed to stop buying Russian oil. Do you think China goes there? Is there any chance of that?
Absolutely not. And I don't think we're even going to push them.
Okay. Shahzad, great to see you.
Thanks
Great to
for
get your
having me.
perspective, as always.
Time now for our stock of the day, rare earth stocks. MP Materials, the largest rare earth producer in the Western Hemisphere, is down now after 2 straight days of gains and closing Monday at a fresh record high. The sector, though, has been up since Friday on reports that China is adding new export restrictions on rare earth minerals. That's stoking another round of trade tensions between the world's 2 largest economies. China controls nearly 70% of global rare earth mining and close to 90% of processing capacity. That means any policy move from Beijing can quickly ripple across industries, from electric vehicles and clean energy to even the chips that power AI. Still with me is my roundtable for today, Lale Akunar, Michael O'Rourke, and Brooke DePalma. And Brooke, I want to start with you here on the moves that we're seeing in some of these rare earth stocks, because a lot of these policy-linked trades, they're gaining a lot of attention this week.
Yeah, we've seen some major moves when it comes to these rare earth stocks over the course of these past few days. We had critical metals jump more than 36% in the pre-market trading. U.S. rare earth was up about 11%. MP Materials up about 8%, as well as others like Energy Fuels and Neocorp also rose about 14 to 15%. And this really is based upon this notion that Beijing's new export controls on rare earth are really designed to essentially force the U.S. to drop these restrictions on selling these chips to China. And so it really is part of this larger conversation undergoing and the impact that these rare earth restrictions could have, and investors really looking to gain when it comes to these specific stocks as well.
Now, Lala, you've said China's rare metals ban could dampen the AI revolution. Walk me through some of that concern and the broader implications there.
Sure. I think, first of all, the market does think that actually this could trigger a fear of supply squeezes, if you will. The fact that they're obviously very dominant in these exports. And also the market is pricing in that the US will simply have to accelerate its efforts to build an independent rare earth supply chain. And these are very important materials, obviously, for magnets used in EVs, in defense, in AI, and in critical tech. And therefore, you could see that the market is being a little cautious in terms of how they price in its effect on the big tech. I also see investor sentiment being affected by this notion of capital rotating into the more real assets, which have strategic utility, and hence the capital flow that we are seeing at the moment. But yes, I think the volatility does tell us that the market is concerned about what it would mean in the short term for the AI trade.
And speaking of volatility, crypto has been on the move quite aggressively since these renewed U.S.-China trade tensions. And this is coming as gold is at a record high. Michael, you've been writing about the so-called debasement trade, which is essentially investors losing confidence in central banks and shifting towards hard assets. Is crypto part of that story at all?
Well, it's been part of that story and been part of that trade. But I actually think that trade is probably has a lot more hype to it than substance. So, like I said, there are underlying notions there, whether it is, expected central bank easing, whether it is, these geopolitical concerns, whether it's fears about devaluation of the dollar or, American exceptionalism being over. What we've seen is this euphoric run, especially in things like, gold and silver, obviously both hit another set of record highs this morning. But I think a lot of this, goes back to the pandemic in 2020, when the central bank wound up doing a massive QE program, more than doubling its balance sheet. And where we are today is we're reversing that process. You just don't see it on a daily basis. But that has, that lack of confidence in governments. And again, that goes from everything from the elections we see to government shutdowns, the inability for governments to pass budgets has fueled this trade thus far this summer into this fall.
China imposed sanctions on 5 of South Korean shipping companies' U.S. subsidiaries effective immediately. This comes as the U.S. also begins collecting steep fees from Chinese ships coming to the U.S. imposed under Section 301. All of this, the latest moves in the tit-for-tat trade war that sent stocks tumbling Friday and again today. I'm joined by Terry Haynes, Pangea Policy founder, and Nazak Nikhakhtar, Wiley Rein LLP chair, who served from 2018 to 2021 in the Department of Commerce as Assistant Secretary and Undersecretary. Thank you both for being here. Nazak, let's start with you. I'm curious what you make of this sort of reignition of these tensions that seem to be set off by China imposing these new rare earth mineral export controls. What do you make of that, and what was behind both the move and sort of the timing of the move?
Yeah, very good to be with you. I actually don't see this as a reignition. China last summer started imposing export restrictions on critical supply chains, critical minerals that we need for the production of semiconductors, other types of critical mineral materials. And over the time, it's been expanding its export controls. And remember, we had the Switzerland negotiations in 2025, the London negotiations that President Trump and his team had in 2025 in London to free up some of these exports. As China's export controls got bigger and bigger, that expanded to more and more critical minerals and some of the strategic materials we need. And China essentially never let up. It maintained its export controls despite these negotiations. We still weren't getting the feedstock we needed. So I don't see this at all as a Chinese reignition. I actually see this as a continuation of Chinese policies that, one, it instituted just about a year ago, and 2, it has been expanding and really never letting up on. With respect to the timing, look, China, what it does, it prepares these measures, and whenever it sees the U.S. sort of getting an advantage on the global scale, moving with respect to more restrictions on China, China needs to save face. That's very, very big for the Chinese government. Save face. So the U.S. makes a move, whether it's export controls, whether it's the Gaza peace deal, et cetera. China makes a counter move to show the world that China is here, and it is now dominated power, and it is now able to rival the United States.
So, Terry, what does that imply for whether progress gets made between the two?
Well, good morning, Julie. And I think that there won't be progress for a lot of months to come, certainly for the foreseeable future. It's frankly not in either country's interest to have any long-term progress. What you've got here is, picking up on the last point, is you've got the sum of a Trump-Gaza brokered peace that included an awful lot of help, interdependence with the major Gulf powers. You've got the U.S.-Argentina bailout. You've got Russia under a lot more pressure from oil to Ukraine attacks. All those things combined are net defeats to China's interests and to its client states' interests, Russia and Iran and the proxies specifically. So, they're not inclined to play nicely with the United States on trade and haven't been for the last 6 months. The markets have talked themselves into the idea that progress is being made, and it's in the United States' interest to continue to have an outstretched hand. But at the same time, neither side is really interested in wanting to move forward here. And among other things, China's reminding us all of that.
I mean, it feels to me like the markets are less concerned with progress than they are about steps back, right? That kind of is the thing that set the market off, that we thought this stuff was at least happening in the background. There was no news. No news is good news. And then you get this post from the president. So, Nazak, where do we go from here? What does this all mean now for these negotiations?
Yeah, I mean, that's the key question. I'm glad you posed that. It's two cool schools of thoughts. One, there's a camp in the administration in Washington, D.C. broadly that believes that negotiations are still possible, right? And there's another camp that said, look, no, look at what we've done. We've been trying to negotiate, and China actually hasn't moved an inch. And so, maybe China's ultimate end game is to not negotiate. And if that's the case, then the U.S. government really has to double down on looking at critical capabilities. China has export restrictions on battery materials and lithium-ion battery technologies, industrial diamonds that we need to make really everything. Shipping, as you just talked about, critical minerals, alloys. We know where China has a stranglehold over our supply chains. We've known for this for over 10 years. And yet the U.S. government, across all sort of sections of the U.S. government, has been a little bit slow into figuring out how to really double down and build our domestic capabilities, which includes Congress appropriating money and the administration, the executive branch, moving swiftly to give companies who want to invest in the United States that money. And then again, shield these investments that are now growing in the United States from predatory import competition, China turning around and dumping goods in the United States. This requires a holistic approach. It requires the executive branch to work closely with Congress. And even if we're able to negotiate our way out of this a blip, rest assured, this is China's card. This is the card that China will play over and over again to discipline the United States and the rest of the world. And this time we need to really get our act together and not be vulnerable.
Well, Terry, us not being vulnerable in these negotiations might open up the market to a lot of vulnerability if the U.S. is indeed going to play tough and hold the line. And the market has gambled successfully so far on the so-called taco trade. I know you've got another acronym, but the idea being that we do abandon the harshest tariffs, even if it's at the 11th hour.
Well, sure. The markets are very binary, on sentiment on this in this area. Either everything is more or less going along swimmingly, or there's the prospect of a crisis, and they swing back and forth. They've swung back and forth just in the last 24 hours or so. Yeah, I suggested, I think the taco thing is dumb, because if you suggest 100% and you get 30%, it's, oh, well, he chickened out. Well, he got 30% and applied it, and you haven't paid attention. My acronym was more like BUSAFE. Both usually step away from escalation, and that is part of what's going on here. Both sides judge, and I think China judged first, that for the reasons I mentioned, that it was time to shake things up a little bit, and, as was said, remind people China was here and that they have interests, and that's all well and good. But the administration so far is not interested in backing off. I do think they end up kind of moderating this in the end, but we will go back to this kind of cold trade peace that exists. But if anybody in markets thinks that either side is interested in actually finalizing a negotiation and moving past all this, I think they're dreaming.
Terry,
I want to add that this.
Yeah, please.
I want to add that this tit for tat sort of countermeasure is just not productive. The U.S. government really has to just understand this is a vulnerability, and this is the card China is going to use against the United States over and over again. And instead of wasting so much energy on tit for tat negotiations, really double down and build the capabilities we need at home, so we're not going to be in this position to be in the next time.
Sure, but that takes years, right? So it seems like they're on the path to doing that, but it's not going to be next year or the year after that. It's going to take a while.
You know what? We've made a lot of progress. U.S. industry has made a lot of progress stemming from the work that was initiated in the first Trump administration and carried through to some extent in the Biden administration. We're just a few years away from developing scaled magnet technology in the United States. We've got incredible battery investments in the United States, investments in super hard materials. Those are the industrial diamonds. I would actually say in about 2.5 years, we will be well on our way. So there's a small gap period to solve, but I think the U.S. has been doing a lot better than folks give it credit for.
Well, investors are watching U.S. and China trade tensions very closely, but some argue the latest standoff won't break market momentum. Our next guest, Michael Kantrowitz, Piper Sandler chief investment strategist, has said don't trade the headlines, trade the cycle. Michael, always great to see you on the show. So I'm looking here, I got green all over the place today, Michael. I mean, obviously on Friday, U.S.-China trade tensions. We have the freak out. Was that just a blip, Michael? And as investors, listen, should we just look through that, past it, full steam ahead here?
Well, I would say the fundamentals of the economy remain are a tailwind for equities. Of course, it's been a while since the markets have been negatively surprised by any tariff headline news. And what we've observed is that the market not only is going to respond to news, but ultimately, whether or not the market follows through with that is ultimately if those issues come to fruition. So really right now, it's really headline news. Nothing explicit time and date has been set. If anything, we've heard obviously positive announcements from Besant and President Trump over the weekend, and it sounds like they're going to be talking. But just the recent behavior and pattern of these tariff headlines, I think, has been quite diminished. But obviously, Friday was a bit of a shock in a market that's been up a lot. So I think people just maybe use it as an opportunity to take profits. But I don't think President Trump's going to do something to disrupt this bull market.
So broadly, Michael, you're still constructive on this market. You're broadly in that camp that says, listen, earnings hanging in there, economy's hanging in there, and the Fed's cutting. Stay long.
Earnings look great. When we look at the breadth of earnings, small cap earnings estimates are at a 2.5-year high. It's been part of the story within that space, which is why it's lagged. The earnings estimates have been going nowhere up until about 3-4 months ago, and now you're starting to see broad-based improvement in earnings breadth, something that has severely lacked in the last 3 years. So we think that's the early signs of a major change in the economic cycle. And we expect to see, as we go into 2026, these declines in interest rates from the short end. We've seen an easing cycle for over a year. Mortgage rates are at the lowest in a long time. Still high, but they're down, and that's all we need. So we expect to see better housing data, better manufacturing activity, and a better, broader economy in 2026.
Michael, I had an economist on the show recently who said, listen, as long as this government shutdown continues, the Fed isn't getting that hard data they want. And the longer it goes on, he says, the greater the odds that at this next meeting they don't cut. I'm just wondering what you make of that theory. And if they didn't cut, how you think the markets might respond.
Yeah, I'm not so sure I buy into that. There's plenty of other data besides government data that the Fed can look into every day, every week. So I'm not so sure that they're just going to not do anything just because there's a bit of an absence. I mean, there's been a trend in the labor data for now, arguably 2.5 years. But it's been very clear now in the last few months, given all the revisions we've seen to the data, plus just some soft ADP data. And obviously, when we were getting the NFP data, that data were soft as well. So I don't think the Fed wants to surprise the market. Thus far, Powell in his term really hasn't, or at least not since COVID. So I wouldn't bet that the Fed's going to pause because of an absence of information. I think they'll just take the information they have that is known and act accordingly. And I think they're probably going to cut once more. Cut in October.
What about, I want to switch gears, just talk to you about the AI theme as well, Michael. We heard today OpenAI partnering with Broadcom. They're going to work together, it sounds like, develop these 10 gigawatts of custom AI chips. AI boom, Michael? AI bubble? What are you telling clients?
I'd say it's more of a boom than a bubble. When we think of bubbles, we think of valuations going to the moon. And of course, there's a lot of froth today. Anytime you're in a market that's at all-time highs that has seen such strong returns in the last few years, you're going to get a lot of speculation at the fringe. But the biggest companies in the market today are printing money hand over fist, which is quite a contrast from the backdrop in 99 and 2000, when the bulk of the returns in the NASDAQ and the tech sector were really coming from multiple expansion. Here's a fun fact. In the last 3 years, the S&P's multiple is up, the small cap multiple is up, but the multiple is not up, the Mag 7, it's down about 20%. So it's all been earnings driven thus far. And if we're back into a easing cycle, I could tell you from studying bubbles throughout my career and reading a lot about them throughout history, is they don't pop when you've got easing money conditions.
Let me ask you, Michael, I mentioned the government shutdown. I'm curious what you're telling clients about that. Is it Listen, as investors, as long as we think it's not going to impact corporate earnings, should we just look through it?
Yeah, I don't see it impacting corporate earnings, nor do I think it's going to last that long where it's going to get to that point. Sure, it's not going to be a week and a half or 2 weeks, which is I think what most people thought it would be. But even if it drags on a little longer, I think looking at all the different macro issues today, that is not a big one right now for the markets. And there's really no clear transmission mechanism into markets and into corporate earnings. Certainly not right now. If this drags on, months and quarters, then maybe we can consider that. But I think it's way too early to be concerned about that issue.
Finally, Mike, I'll just get you out of here. This broadly, I'm just curious, where do you see the opportunities in the market? What are you screening for to own and to avoid?
Yeah, well, I'd say where we're most at a consensus, and this has been a theme of ours for a couple of years, that rising unemployment is a bullish catalyst for equities, and that is just not a idea that people are really think is intuitive. And obviously, it's counterintuitive to some respect because the last two recessions of 2001 and 2007, that was quite the opposite. But actually, if you look throughout history in periods of rising unemployment, you actually see stocks go up more often than they go down. So we're seeing that the last 2.5 years. So we would be recommending areas that would be typically labeled as early cyclicals and other cyclical areas, financials, banks. I think home builders do well in a backdrop where the labor market's soft and rates stay low. Some consumer discretionary areas that have really been kind of underperforming. So, I think this is a time where the laggards can start to see some relative performance, something that's, again, been absent for the last several years. I don't think we're going to be seeing a big economic boom coming out of this, so I still think you want to be selective. But I think we're seeing a broadening into 2026, and I know people have been calling that for years. This is the first time we're making that call, and we see a lot of green shoots that support it today.
Michael, always good to see you on the show. Thank you, sir.
Yep, my pleasure. Take care.
Well, this week, gold hits a fresh all-time high as investors flock to the precious metal. For more on what to make of this shining trade, we want to welcome here Merck Investments founder, president, and chief investment officer, Axel Merck. Axel, as someone who, manages over $3 billion in precious metals and precious metals mining, I want to start with you on what you just make of this record run in gold. Axel, what, in your opinion, is driving this?
Yeah, great to be with you, and it's indeed been truly astounding. Just for reference, we more than doubled our assets under management over last year, and I would say it's our brilliance, but more likely it's just the trend in there, in that space. Historically, we have different types of investors in gold. The diversification investor, the gold bug concerned about the purchasing power. We have the speculator, and we have the central banks. Noteworthy is that the speculator is not very loyal, but in recent weeks has seen that there's a trend in gold, has jumped on it. Obviously, as we're talking today, that's been somewhat going in reverse. The main buying we have seen, I would argue, and from our analysis, has been from institutions rather than retail. And that's very noteworthy because historically, when you reach these all-time highs, it's a retail frenzy. I cannot say that we see a retail frenzy. It is institutional buying. You can attribute it to the quote-unquote debasement trade. It's mostly, I think, institutions diversifying because that's one of the things to diversify to, but obviously that's gone up. Gold has gone up quite a bit in recent months.
Can I ask you, Axel, if one reason, one big driver, it's the central banks, is that also potentially, Axel, a downside risk? I mean, if that's true, then what would happen if the central banks stopped buying or even started selling, Axel?
Well, first of all, central banks historically are not very price sensitive. So if they have a mission to do something, they'll execute on that. I think the reason we have to think about why are central banks buying, and I think it relates to the weaponization of the dollar a few years ago when the dollar has been used as an active tool to react when other countries don't act the way that it's in the U.S. interest. And that is a quote-unquote incentive to the central banks to diversify their reserves. It doesn't mean that all the reserves are piled into gold, but it means that gold is a beneficiary of that process. And so the question to me is, what could get that trend into reverse? And I don't see that. We see an increased national activism throughout the world that monetary tools, fiscal tools are used to defend the interests of a country. We've gone away from globalization where we're all a happy family. So I think the risk is that we have globalization come back where we have this period where the global wheels of finance are oiled through trade. The one thing I'd like to add, to digress a little bit from your question, is that when you have tariffs, you don't just impede the flow of goods, you impede the flow of money. So if you think that tariffs are going to go away, that's a somewhat related risk. And of course, the Supreme Court can throw a wrench into that if you believe that tariffs are a good thing. And so that's the sort of way I would try to look at the issues of quote unquote central bank buying and beyond.
You know, Axel, even some long time gold bulls, like my friend, the strategist Peter Bukvar, they've trimmed a touch. Peter, very smart guy. Here's what he told his clients this morning, Axel. I want to get your take on this. Peter told them, I still believe the ultimate highs of this bull run are ahead of us, but acknowledge when excitement gets to a very giddy level, it's time to call a timeout and for portfolio management reasons, take some chips off. What do you make of that?
Well, I'll give you two answers. The first one is extremely difficult to time the markets. And while, of course, everybody has seen how much the run-up has been, nobody knows what the price is going to be tomorrow. The other thing I indicated earlier is that the speculator is back. The speculator was in meme stocks, in crypto, in SPACs and whatnot, and used to be in gold and is somewhat coming back. What that does is increase volatility. And so all else equal, if a portion of your portfolio is more volatile, if your risk profile hasn't changed, yes, you would want to pare back. So I'm giving you the same answer that the other guest there is giving, but I'm giving you a different way of doing it. Rather than giving a macro reason, giving a portfolio reason how that behaves. Taking chips off the table, rebalancing on the way up is prudent management. We can't give specific investment advice. As far as we are concerned as a company, we have an institutional mandate and we can shift within what we do on the mining side. But we have as a mandate to be invested in that sector.
Axel, I only have about a minute left, but I got to get your thoughts on this. You know, we've been talking gold. What about digital gold, Axel? What about Bitcoin? I'm curious to get your take on the moves we're seeing there.
Well, you had a segment on Bitcoin earlier. I think the key difference is that gold in the long run has a near zero correlation to equities. It moves in and out, whereas Bitcoin, especially in recent years, has been very correlated with risk assets. And that is, I think, part of the reason why people have moved more towards gold. I'm not saying that will always be the case in Bitcoin, but for the time being, as far as the diversifier is concerned, gold has the heads up. I've sometimes said that Bitcoin still wants to decide what it wants to be when it grows up, and it's going through that maturing process. For the time being, it is very correlated with risk assets, which is great for speculators, but currently they're a bit disillusioned because they are expecting a lot, and the Bitcoin hasn't delivered in recent weeks anyway.
Axel, great to have you on the show today. Thank you.
My pleasure.
What are we seeing across the safe haven space? Because there's been some pretty eye-popping moves, even just over the past week.
Most definitely. I mean, gold is headed towards its best week since 2020. You have seen record after record. And when we saw equities selling off yesterday, you saw gold that was still hitting all-time highs. Now, gold is sort of right now easing a bit. It was going towards 4,400. It may have some resistance around that level. The question is this big, massive rally that we've seen in the gold space as a safe haven. What is this telling us about the economy? What is this telling us about the future? What is it telling us about money printing, about the expectations of the Fed easing? Is it easing because the economy will be deteriorating, especially now given what's happening with the regional bank woes? So those are some of the questions surrounding gold. But still, you have seen this massive rally year to date. If we do start to see some pressures with equities, if we do start to see some heavy selling, then you could see margin calls and you could see gold selling off. But keep in mind,
big buyers are central banks here, and the central banks won't be selling. They are not sellers. They are stuck buyers when it comes to gold.
Yeah, and as gold continues to rise, we've seen some serious sell-offs in Bitcoin. Just over the past 5 days, Bitcoin is down 8%, trading just around $105,000 a coin. And in the meantime, you have oil that has really come down. That's led to the lowest gas price, I think, since January. What's sort of driving those two moves?
Right. Well, with respect to oil, you have the situation with Russia and Ukraine. Today, President Zelensky of Ukraine is going to be meeting with President Trump. He had a conversation yesterday with President Putin. So if you do start to see Russian oil flowing more freely, then that would sort of go in line with the oversupply that the market is expecting. And the market analysts are expecting that next year you're going to see oil prices that are lower because of an oversupply in the market. You have OPEC Plus that's also increasing its supply. With respect to Bitcoin, you've had a lot of leverage calls. You've had long liquidations. You had the mini crash just last Friday after President Trump announced those threats, tariffs against China. So Bitcoin has been a little bit of a head scratcher for the Bitcoin bulls, because this is supposed to be sort of a stellar month when it comes to Bitcoin. And the Bitcoin bulls are expecting that you would see some rotation going from gold into Bitcoin, with that rotation being sort of a historical rotation that gold front runs Bitcoin. So it has definitely been acting like a risk on asset, and investors have been fleeing from that risk on asset.
Gold just keeps shining, hitting new records as investors flock to the precious metal. Some people buy gold coins or bars and store them at home or in a safe deposit box. But for others, gold has become a way to save for retirement through what's known as a gold IRA. Now, opening a gold IRA isn't as simple as opening a regular one. Most major brokers, think Fidelity, Schwab, or Vanguard, don't offer them. You actually have to go through specialty providers, and the rules are pretty strict. The gold or even other metals like silver, platinum, or palladium has to meet certain purity standards, come from approved refiners, and be stored in an IRS-approved facility. Then there are the costs. Gold IRAs typically charge more than traditional IRAs, including setup, storage, and maintenance fees, plus insurance and shipping costs. And unlike cash or stocks, physical gold doesn't pay interest or dividends, so you're not earning income while you hold it. Taxes are also different. The IRS treats gold as a collectible, which means long-term capital gains can be taxed at up to 28%. That's higher than the 0 to 20% range for stocks. Still, gold IRAs do share some traits with traditional ones. You can fund them with pre-tax money, and Roth Gold IRAs allow after-tax contributions. But just like other retirement accounts, you will face required minimum distributions starting at age 73. And if you want gold exposure without the hassle of storing bars, there is an easier option: physically backed gold ETFs. You'll pay a small fund fee, but no storage or insurance costs. You can even hold gold ETF shares inside of a regular IRA. This gets you many of the same tax benefits without opening a separate account.
Well, U.S.-China trade flare-ups and increased bets for a Fed rate cut have sent gold prices soaring. The precious metal trading above 4,200. Blue Line Futures. Phil Strebel joined us to weigh in on the next moves. Phil, great to see you on set, especially, my friend. Let me ask you this big picture question. I want to start U.S.-China trade tensions. They're ratcheting up. You saw Treasury Secretary Bessent, Trade Rep Greer, not happy, Phil, criticizing Beijing, specifically not happy with Beijing's decision to curb exports of rare earths. I'm curious to get your take on how you see that. Specifically, just walk me through, as a trader, how you're navigating all that.
Well, when you look at the rare earths, you look at these different commodities, and what the commodities do is they fuel defense, energy, AI, and technology. Without these rare earth elements, you're unable to produce any of these things. I Google searched and look at AI and saying, hey, can we survive as a planet without magnets? And that's where a lot of this argument is. If you don't have these magnets, you can't create energy. And without that, you're going to see technological advances just not happen whatsoever. Inside of this studio, there must be thousands of things that are running on these magnets. And that's where the argument lies on us getting these magnets.
Let me switch gears. I want your take on precious metals. Let's talk gold specifically. Here's what B of A says, and obviously it's been a run. It's an 8-week streak of gains for gold. B of A sees the risk of correction near term, Phil. Then they tell clients, though, still further upside in 26. Is that how you see it?
It's the volatility is where they see this possibility for correction. You've got about a $90 average true range, meaning that gold is moving about $900 on the 10-ounce contract per day. So you look at gold's up about 50% year to date. You've got 17% a changeover in ETF flows. So coming in year over year, we're getting much more active in this. What's happening is people with traditional 60-40 portfolios, they've been left in the dust over the past few years. It's important for them to start incorporating slivers of commodities into their portfolio, whether it's gold, oil, Bitcoin. And what it does is it allows them to perform better. So it's the widespread adoption from not only the individual investor, but also central banks continuing to add.
Can I ask you, when you looking at gold, what are the levels you're watching?
So 49.37, that would be the recent swing low that we just saw. That would be a little bit alarming if we break below that level. Realistically, the way this thing is charging higher, Bank of America with a $5,000 price target at the end of 2026, the reality is that we could just get there in several days. If you look back at the breakout, which was September 1st, that was above $3,500, and look where we're at right now, $700 higher within a month and 2 weeks.
Silver, I want your take on that one. Again, B of A, I'll give you a take. They see that when they told clients potentially rising to 65. Is that what you see?
Yeah, the possibility is really there. You've got a number of different dynamics. It's up 70% year to date. The silver market is only, the market cap's about 50 billion. You look at gold, it's 450 billion. So it's 9 times smaller, and that's where the volatility takes place. You've got 5 years of structural supply deficits, meaning the mining supply just isn't there. And you've got the demand constantly increasing, everything from EV, solar. Solar is tapering off a bit, but countries like China are really starting to try and become energy independent, and that's where they need silver and some of these different elements.
So the reasons driving silver higher, different than gold in some respects?
Oh, definitely.
Yeah.
And plus you've got the investor demand that's coming in there. It's that poor man gold mentality. Now it does have the risks, and it does attract the type of person that chases after something like Bitcoin, something like the meme stocks. Silver's the next one. They dream about getting rich on these things. Where the gold market has this structural supply where you have central bank demand adding to that support there. The problem with silver, the only one that I would say, is that you have the possibility where you have substitution risk, where if prices get too high, you produce solar panels, you might start incorporating more of a copper paste or an aluminum paste instead of silver. So it does face that type of risk.
Platinum and palladium, I want your response there too. Macquarie saying, here's their take, PGM prices could see a pullback, they told clients, but they think the dip gets bought. Prices make new highs during Q1. Is that what you see?
Now the problem that occurred was that prices of gold and jewelry and watches, it just became too great. So what happened is in China, they started looking at inexpensive ways to have great jewelry, and they started buying platinum, and that's where you saw that breakout over $1,000 an ounce, and it's really taken off from there. It's up near $1,700. Your level of support's $1,500, and you also have palladium where getting these things online, getting them out of mines and extracting them, a lot of these countries that do that are using it for negotiations towards different trades and tariffs.
Finally, let's touch on the energy complex. Gasoline prices, when you're in the $3 threshold, as oil prices tumble, I'm just looking at WTI, Phil, 58 and change. Where does it head from here?
This is why we have the afterburners going on in the U.S. equity markets. You've got growth right now. You've got declining inflation with these energy prices coming down, as well as lower agricultural prices. I really believe that they want to see oil in those low to mid 50s. So 55 to 52, I think, would be a great level of support. There's no telling on natural gas, where they've been building these inventories, what the weather is going to bring when it comes to the winter. But we do have ample supplies, and that's why the futures are breaking below $3.
Phil, great to see you. We're lucky to have you on set. Thank you, sir.
Thanks a lot, Josh.
Gold's on pace, in fact, for its best year since 1979. And while many are buying and holding on to their gold, for a look at what it means for pawn shop owners, I want to bring in Rick Harrison, who you may recognize from the TV series Pawn Stars. He's also the owner of the Gold and Silver Pawn Shop in Las Vegas. Rick, it's good to see you. Thanks for joining us.
Thanks for having me.
So we've seen prices go up. Does that mean like a huge influx of traffic into your store with people who want to know what they have, how much it's worth?
I am buying a little bit more gold, but it's hurting on the retail side. When people come in and they go to, they get serious sticker shock when they start looking at jewelry. 14 karat gold, it scraps for like $75 a gram right now. So, when you come in to buy, retail, buy a ring for, a little 5 gram wedding band, and it's like $700 retail. I mean, it's, people are a little shocked.
And so that implies to me that you, in other words, you're not eating the cost, right? You're hanging on to your margins and you're raising your prices with the price of the underlying metal.
Yes. Even if I bought it, like say I bought something a year ago, I'm not going to, I'm definitely going to sell it for more than I did last year, because if I sell it for what I had priced last year, I could actually just put a torch to it and sell it for scrap and get more.
So, so what kinds of changes then are people making? Like, if they're coming in and they're getting that sticker shock, is there any jewelry that is more reasonable that they're pivoting to right now? How's that playing out?
A lot more people are buying like silver jewelry, things like that. I don't see a stop in the prices going up either. I mean, it just, there's a massive deficit in the amount of silver we have in the market right now. There's no silver mines left. I mean, all silver production, it's ancillary from copper mines and gold mines. So I think there was a 150 million ounce deficit last year when it came to silver. So that price is going to, just supply and demand, that's going to go up. And central banks are buying gold like crazy. So
you have any tips for people out there who have jewelry at home that they're thinking about selling? Do you think they should hang on to it? Do you think they should get it assessed? What do you think?
I think they ought to hold on to it for now. I do not see a stop in the price going up. India broke a record last month on the amount of gold imports and silver imports. China's buying gold, tons of gold every year. Central banks around the world are getting rid of U.S. bonds, and it's the whole de-dollarization thing, and they're buying gold. So I just don't see. I see it going up for a while.
Rick, I want to ask you too just about the underlying business, right? You being in Vegas, big tourist destination. Have you seen decreases in traffic? Are fewer people coming to Vegas and coming into your store?
Actually, the last month has been really, really good. I mean, the actual amount of people coming in the store has gone up. I do know the actual number of people coming into Vegas has gone down a little bit. But I think it's a cyclical thing. I've said this before. I think, we're kind of suffering from a COVID hangover. Everybody during COVID got so much money and they were spending that money. And when the mask came off, everybody went on vacation. And I think it's just slowed down a little bit because of that, but it'll be back. And I think the hotels on the Strip have got the message that, stop charging so much to have money. And I think they're listening a lot.
And what about pawn shops as an economic indicator, right? I think about on both sides. Obviously, there's the retail business that you talked about, but there's also people coming in because they need to raise cash, right? So, what are you seeing on that front lately? And are you seeing that kind of as a sign of stress or not in the economy?
That I see holding kind of steady right now. So I don't see an uptick in people wanting to come in, more people getting money. So I think the economy's kind of flat at the moment, and everyone's still kind of a wait and see attitude, but I don't see the economy down at the moment as far as in that respect.
Are you seeing any kind of change in stuff that's moving in the store?
I will tell you that every time I get gold bullion and silver bullion, we'll get a shipment in the morning and it's gone by 2 or 3 o'clock.
Wow.
Literally, I mean, we cannot keep any of it in stock.
And what about collectibles, for example?
Collectibles, that's a weird market. If the price of one if one group of collectibles really goes up in price, it usually affects another group of collectibles that'll go down. Pokemon cards are kind of flat, but they're still bringing money. Disney stuff over the past couple of years has really gone down. It's hard to sell Disney stuff, and I think that's because some of the moves Disney has done. But generally, coins have gone really up. A lot of people are, buying like coin collectors. They've always been around, and yeah, in general, the market's pretty, decent and hasn't. I don't see any giant jumps in anything here lately. Like I said, the only thing I've seen go down in price over the past couple of years is Disney stuff.
Interesting. All right, Rick, thank you so much for joining us. Appreciate it.
All right, thank you. Have a good one.
You too.
Gold still shining, hitting fresh record highs and pushing above 4,100 an ounce. This comes as President Trump floats more potential tariffs and investors flock to safe havens. But our next guest says the rally, it's more about fundamentals than fear. Joining me now, we got David Miller, CIO and Senior Portfolio Manager at Catalyst Funds. David, great to see you as always. So first big picture, let's talk about what's kind of just driving this run in gold. You put it like this, David, you say the move to all-time highs isn't just about fear, it's about fundamentals. Explain that for us, David. What do you mean?
Well, so it's certainly not just one thing. So I guess to start, an easy way to think about it would be those China tariffs you just mentioned. If you think about it, if you're China and you're running the Chinese central bank and you own 760 billion of US treasuries, and you just saw that the US was threatening 100% tariffs, and you saw that back in 22, the US seized 300 billion of Russia's dollar-denominated assets, you'd probably feel a lot safer if you held 760 billion of gold bars in a vault in Beijing that we couldn't take at the flip of a computer switch. So that's probably a starting point, is you have these price agnostic buyers, and it's not limited to China. They're not the only people we put tariffs on or indicated that we may not agree with their policy and don't want us to have that leverage. So they're an enormous buyer, over 1,080 metric tons last year, and they'll likely do more than that this year, meaning the central banks, particularly of the BRICS nations.
Central bank buying, it's an interesting trend to watch. Is that in and of itself, David, enough to keep gold moving higher?
Absolutely. The central bank buying is enormous because if you think about it, the US dollar as the world's reserve currency fundamentally started to shift after that weaponization of SWIFT in 2022. And then it really just poured gasoline on that fire when you added the tariffs to it earlier this year.
What about U.S.-China trade tensions? I mean, you saw that caused a freak out in the markets on Friday. What role do you think that's playing here?
I think that's pouring even more gasoline on the same fire. So, I mean, there's already this concern. We already had these tariffs earlier. We already had specific Chinese sanctions. So any addition to that just makes people want to transition off the dollar faster and buy more gold as a reserve asset.
Let's put some numbers on this. What are your gold targets? What do you pencil in?
So it's obviously been moving pretty quickly. We just got over 4,000 an ounce not too long ago, then starting to crack 4,100. I think middle of probably end of this year, you're probably looking 4,500. You could even see 5,000 plus a year from now. A lot of it obviously depends on those fundamentals and how they shift over the next few months and year.
For gold investors who are listening right now, what are, David, near-term risks you would emphasize that they need to have on their radar?
So obviously the price has obviously moved a lot. So whenever you see an asymmetric move like that, there's always the risk that it will retrace. I think the reason that's less of a risk right now is we have the Fed lowering interest rates. That's generally good for both bonds and gold. You also have the central bank buying. That's generally accelerating. So that's also pretty good for gold. Obviously, if either of those were to flip and they flip to raising rates or they flip to central bank selling, that would shift it, but there's no indication that either of those two are likely to happen. And then you also have deficit spending, which is the other big driver, which is also weakening the dollar because when you have 37 trillion in debt outstanding and you're running a $1.9 trillion deficit that was kind of enshrined into law in the big beautiful bill, those factors are very structural. So obviously if any of those shift and they flip to selling or they start raising rates, or we see the government decide to run a balanced budget and create a new bill, that reverses previous ones, that could change, but I don't think that's terribly likely in the near future.
So those are near-term risks. Would there be some potential near-term positive catalysts? Would it be like the next FOMC meeting?
Certainly. So, I mean, if the Fed decides that they're going to loosen policy and cut rates more than they've already indicated, that would certainly be a net positive for gold. If they decided that they were going to cut less or not cut, that wouldn't help gold prices. And you can think of gold in relation to the dollar from that perspective. Whenever the dollar weakens, that's a big net positive for gold on a relative basis.
What have gold ETF flows been like?
So gold ETF flows had been flattish the past couple of years in spite of the rising price, whereas year to date they've really started to take off in a much more significant way. They're not nearly as big as the central bank net buying, but that's an additional part of that cycle. The price escalation has attracted more buyers. It's certainly one of those situations where it's kind of a bit of the opposite of the store sale. People like buying gold more when the price goes up, ironically.
When friends and family come to you, David, they say, how do I get exposure to gold? What's the smart way? Do you say physical gold? Do you say ETFs? Do you say miners? Do you say all three?
So I think all three could have their value. So we've kind of approached this on our own. So we've created one ETF. It's called the GOLY ETF, Gold Enhanced Yield ETF. And what that does is it buys gold futures because gold itself doesn't pay a yield, but gold futures do deliver the price returns of gold, but it frees up the rest of the money in our fund that we can put it to work, generating income in investment-grade corporate bonds that throw off a 5% yield to maturity. So we can stack that 5% yield on top of those price returns that we're getting from gold futures. That's been great for our fund. It's been up over 50% year to date. You can also own the physical. That's certainly the cheapest way to do it from a storage cost perspective or management fee perspective, but then you have the risks of selling it. You usually have to sell it at some type of discount. You're paying a premium when you buy it, whereas that's not really true in the futures markets or when you buy an ETF. Aside from the ETF route, though, gold stocks have gotten considerably more attractive because gold stocks really trade off of their margin. And when you think about it, over the past few years, gold prices had gone up, but their margins hadn't really improved significantly because the costs associated with gold had gone up with it. That really started to change this year as their margins really started to widen in a significant way because the gold rally has been much more significant than any costs associated with mining gold so far in 25.
Final question, David. I'm just curious, what would you have to see? What would need to happen to really kind of weaken your fundamental constructive view on gold? What's the headline where you would say, okay, that's a sell signal?
So we started to have some of those earlier this year, although they reversed. So earlier in the year, the government was talking about DOGE and what they were going to do to cut deficit spending and cut $2 trillion off of spending. And that would clearly be a net positive for the dollar, and that would be a net negative for gold. Now, they didn't follow through with that, but if they decided to reverse course and try to do massive DOGE-type cuts, that could certainly have an impact. If you had the government say, hey, we're going to drop all these tariffs, we decided we're going totally for free trade, that would be a net negative for gold, although that doesn't seem to be the trend right now either. Or if you had the Fed reverse course and say, hey, we're actually going to hike by 50 bips over the next few months.
You're outlining what sounds like some pretty low probability events.
And that's, I think, why gold's been rallying, because you have all these factors that are tailwinds all working at the same time.
Yeah, David, always great to see you, especially on set. Thank you, sir.
Oh, thank you.
Precious metals are on a historic run. Gold holding above $4,100 an ounce. Silver just topped the $50 mark. Joining me now on the commodities, precious metals trade is Bob Iacchino, Path Trading Partners Chief Market Strategist and co-host of the Futures Edge podcast. Good to see you, Bob. So it's been all about gold, but now we are really seeing it spread in more dramatic fashion to the other precious metals as well. I mean, what do we think here? How far can this gold run go?
Well, as you're probably seeing, Julie, it's good to see you again as well, by the way. Silver has obviously just reached a new all-time high. And the interesting thing is when you look at the performance, I flipped positive precious metals in November of 2023 on this show, actually. And if you look at silver, silver was not on my radar at all. And you compare the performance of the two since then, gold's 133%, it's just short of 134%. Silver's now about 130.5%. So right on the heels, and most of that movement has been lately. And I think it's in part due to the nature of the Fed rate cuts that we expect to see coming. Nobody is saying that the economy is slowing dramatically. It's clearly slowing. But if you get rate cuts, now you're seeing the industrial part of silver and the safety part of silver kicking up a pretty good fire behind silver to have it catch up to gold. The silver to gold ratio has been out of whack for quite some time now. And then on top of that, silver is what people call the poor man's gold. I don't think anybody that's been in precious metals is poor lately, but it's been known as the poor man's gold. As gold rallies up, the reason for the catch up between the silver and gold ratio is people start to think that silver is overdone, and gold is overdone and silver is a cheaper alternative. That isn't necessarily the case. I think what's driving silver now is the combination between the industrial use and the precious use of silver. Gold, on the other hand, I had a $4,000 target. It's blown through that. Kind of working on a new target that maybe I could tell you guys by the end of this interview.
You're thinking while you're talking on what the new target should be. Talking. Interesting. I've also been reading a little bit that's in terms of silver that there's maybe a short squeeze going on as well. Again, what does all of this tell us about the sustainability of the move and how much it's going to keep going?
So here's what I'm looking at for that. The interesting part about gold over the last 2.5 years, as the corrections have been sideways in price. Now, unless you look at charts as often as I do, I tell people all the time, I'm probably 30% fundamental, 70% technical. Lately, I've been leading 80% technical because with President Trump, the fundamentals have been kind of out of whack, especially for precious metals. When you look at it from that perspective, gold's corrections have been sideways. And people don't necessarily look at those as corrections, but I do. When you have a strong trend that all of a sudden levels off and goes sideways, that tells you something about the psychology behind that particular asset. And the psychology of gold has been, I don't think it's going higher, but I'm not going to sell it. And that's really sort of a short-term comfort with the position. So when the next crazy thing happens in the market that drive people to gold, some people are already in it, but other people have FOMO and they drive it higher. So for me now, we are looking for a downside correction in gold. Today, tomorrow, that could be the exhaustion. I'm not willing to sort of pick a top on gold. But I think if we get a move back down to 3,600, I can then put 5,200 up as the 2026 target for gold because you'll get that sort of exhaustion. But as I look at the overall fundamental case for gold, I can't see a reason for it to drop precipitously and stay there. There's just too many moving parts for gold right now that drive its nature. You look at, for example, Friday, when we had the threat of tariffs that you guys just talked about, the Chinese tariffs. Gold is the only thing that rallied. All other risk assets dropped, and I'm not putting gold in a risk asset, I'm just saying Bitcoin dropped, which again gives you this idea that Bitcoin hasn't quite reached gold status yet as a pure safety asset. It's still too correlated to the moves in the NASDAQ. Now we see the NASDAQ futures, obviously the stocks are closed, NASDAQ futures are up 2%, and Bitcoin is rebounding, not as much, but a little bit off of its lows.
Right.
So it tells you that gold is still the safety asset when it comes down to it.
Yeah, I would hazard a guess there's a lot more margin buying in the crypto market than margin buying of gold, but I don't know. That's just a guess, Bobs. Okay, so your new target, did I hear you correctly, 5,200 for gold?
Yeah, I really don't call that number with the idea that there's going to be a sideways correction in gold again. If there's a sideways correction, I'd put it more at about 4,730. But if we get a correction to about 3,600, my new target will be 5,200. It's based on the play. You know, when you get a sell-off, you get people that have been sitting on the sidelines saying, I should have bought gold, getting in again. When it just moves sideways, those people tend to not get involved. They tend to wait for a sell-off. So I'm talking 4,700 to 5,200 in 2026.
So, Bob, that could keep going higher. We talked about silver. I'm also curious about, say, palladium, platinum, and that part of the trade. Do you expect that to continue to sort of also catch up and participate?
I don't feel like platinum is going to catch up because it only has really one use, and that's in a use that's kind of evolving away. Right, and internal combustion engines is its strongest use. We have had a dip in electric car purchases, but then we had a spike just past that. So it was almost like a correction in electric car purchases. I expect electric car manufacturers to actually find ways around the tax breaks that have expired now. I think they're going to find ways around that. I don't know what those ways are going to be. Tesla already announced some financing advantages for going into Tesla. They make up about 2,500 of the 7,500 that went away. So I think they're going to work through that, and that could potentially stabilize platinum. Palladium's a different story. There's other uses for palladium. It's a rare earth, it's a precious metal, and I think palladium will continue to rally as well.
Bob, great to see you. Thanks so much.
Good to see you as well.
Bitcoin broke out to a new high of 125,000 and change in early October, and it quickly fell back into its old trading range. But guess what? October is historically one of the best months for Bitcoin, so on today's Stocks in Translation, we are taking a look at Bitcoin seasonality and the next potential catalyst for the king of crypto. And just a quick reminder that seasonality refers to those recurring patterns that we typically see year after year. And in this first chart, we're taking a look at each month of the year broken down, and it's 2018 to 2024. Why did we start at 2018? Because that's when we got Bitcoin futures, and that's when Wall Street started taking notice of Bitcoin. If you go back further, you really have a different animal on your hands. But what stands out here is a few really positive months. So that's 18% in July, 11% median in February, and in October, also an 11% median. And I'm using the median instead of the average because that's right in the middle. If I use the average, you tend to get bigger numbers to the top side and then bigger numbers to the downside in the negative realms. But what you're going to notice here too is that after October, November and December, they skew negative. So unlike stocks where you typically get that end of the year rally basically from October through December 31st, not necessarily so in Bitcoin. However, we do have this positive catalyst right ahead of us. And here's another look at the month-by-month breakdown with win percentage. And what really stands out here is October is 86% positive going back to 2018. And that ties February over here, which was also a good month. And it's a bit bigger than July, which was the best month. So odds are working in the bulls' favor here. And one more thing is that if you break it down on a day-by-day basis, I have the entire year here from January 1st to December 31st, and in white is what the map is telling us. That's, again, the median from 2018 to 2024, and the green 2025 year-to-date. We are right now at the period of time when it historically inflects up. And so the middle of October into the first week of November is a very seasonally bullish time of year. And you can see how some of the swings that we've had in this year, and there was some interruptions, albeit with the post-Liberation Day sell-off, a lot of the recent swings have kind of coincided with the map. So things are definitely working in the bulls' favor right now. We'll have to see what comes of that. And let's take a look at what to watch now, because Bitcoin investors should be paying attention to a number of things. First, we have bank custody of Bitcoin and crypto assets that's starting to roll out right now. The SEC gave the green light on that way back in January, but banks have lots of regulators. They tend to move slowly. So many investment advisors have been waiting for the safety of bank custody, so watch out for these press releases from some of the biggest players. Then, number two, the ghost of Mt. Gox still haunting the blockchain. Way back in 2014, the world's largest crypto exchange failed spectacularly, and most of the confiscated coins has been distributed back to the owners, but we're finally up against a hard deadline on Halloween, October 31st. How fitting. There's a small chance that some whales could emerge and dump their new holdings after getting repaid, but that's just a small risk. Then, in the spring of 26, the IRS is rolling out new tax forms to report crypto sales. It's going to be a little bit more of a burden for crypto traders, and there could be a few jitters around tax day, but it's still a pretty small risk. You do have to watch ETF flows because something is definitely going on there. Spot crypto funds have raked in $40 billion so far this year, and any let-up in flows could signal lower crypto demand, which impacts price. And finally, watch the current trading range in Bitcoin, which has been in place since July from roughly 108,000 to the downside to 125,000 to the upside. And remember, Bitcoin is famous for its rug pulls and false breakouts, both to the upside and also to the downside.
Josh, definitely October not going well for all of crypto. In fact, since last Friday, you've had the crypto market that's shrunk by 600 billion. And if we take a look at our Wi-Fi Interactive, you'll see the action here today. We are watching Bitcoin that is around 106,000. It had gone down to around 104,000, 105,000 earlier in the session. But if we just take a look, I'm just going to pull up here a 10-day chart. You can see down 12% over the last 10 days. We had seen Bitcoin at 126,000 at an all-time high back on October 6th. Then last Friday, Trump put out that social media post threatening China with 100% tariffs. And that's when you saw crypto really decline tremendously down to around 104,000 level. You had leveraged positions, you had long liquidations, and that really was what precipitated all the selling. Now you have had a choppy week, so to speak, over the last 5 days. But nevertheless, this has been a disappointing trade when you compare it to the likes of gold, for example. Even though gold is down today, I mean, gold has been sort of the safe haven. So even though today Trump talked about how the tariff talks are going well with China, and we've seen that the markets are up overall, but you're not seeing Bitcoin going up. So it's a bit of a head scratcher when it comes to some of the Bitcoin bulls out there, because this is supposed to be a strong month. And a lot of the big thesis has been that once gold had its rally, that you would see some of that money flowing into Bitcoin. We have yet to see sort of that rotation from gold into digital assets, cryptocurrencies.
Let's just first start off with the moves that we're seeing, because October is typically a month where we see crypto perform well. Not the case this time around.
Listen, when there are shocks in the system, people sell what they've got a profit in, and crypto's up this year. And so I think this is just people taking profits, which is healthy.
Okay, profit taking. But there is this push to launch more crypto ETFs. We've seen various brokerage firms saying that this is something they want to do more of. But money flowing out of those ETFs, like we just said, is that a concern at all when it comes to supply and demand dynamics there?
I think year-to-date flows are certainly net positive, and I think you'll see them continue to grow over the next few years. The Solana ETF filings are obviously out. Fidelity, VanEck, Franklin Templeton, Bitwise, and others. And many have recently updated their S1s to include fees, which is usually the last step in the process. So hopefully more ETFs coming soon.
And explain to me the difference when it comes to Bitcoin, Ethereum. You were just talking about Solana. I feel like for early crypto adopters, maybe they're just concentrated on Bitcoin and Ethereum. Why should Solana maybe be part of the conversation?
Yeah, so the total industry market cap is somewhere around 3 trillion. Bitcoin being the dominant position in that. Ethereum being the second largest and Solana being right behind it. And so I think if you want to have a diversified portfolio, you probably want exposure to all of them. But the important thing to remember is what the differences are between Bitcoin, Ethereum, and Solana in terms of the asset as well as the technology. Bitcoin is typically seen as digital gold, Ethereum, digital oil, and Solana is the fastest growing technology platform in the world. And so if you want to think about having exposure to the Mag 7, which has driven a large part of the S&P's growth this year, you also want to include Solana because it should be part of that story with Meta, with Google, with OpenAI, with NVIDIA, and those types of companies.
And how can investors get exposure to Solana? Is it through those ETFs as well?
Soon. We've got a number of large asset managers, including Fidelity, have filed for Solana exchange-traded products, and currently there's a government shutdown, which has delayed the SEC approving some of these S1s, but I think you'll see them hopefully approved soon. There's also a large and growing number of DATs, digital asset treasury companies, similar to what Strategy has done for Bitcoin. There are now a number of these that are supporting the Solana ecosystem, including Forward Industries, which raised $1.65 billion a couple weeks ago.
So with these ETFs set to come down the pipeline, how is Solana really positioning itself to grab that investor attention?
Yeah, I think it's a really clear narrative, which is Solana is among the fastest growing technology companies in the world. And with staking, Solana also prints, a 7-9% yield by staking and generating the rewards from that.
And on a volatility basis, does that make Solana maybe less volatile to some of the moves that we see in crypto and Bitcoin, I guess, more generally?
Crypto is one of the most volatile asset classes out there, and I think folks that allocate to the asset class do it in part for the vol, right? You get the reward with the risk, and I think that's something that you want in a diversified portfolio.
And part of that volatility story has just been the embrace from the Trump administration, right? That's led to a lot of the gains that we've seen. So how has this administration really changed the trajectory for crypto?
It's been just such an enormous lift for the industry. Obviously, the executive branch has done a lot. We've seen administrative action from the SEC, CFTC, and other administrative agencies, but also, most importantly, you saw a legislative branch act with the Genius Act passing earlier this summer, and that has created an absolute groundswell of activity in the stablecoin space and more broadly in tokenization.
Yeah, you hear the word stablecoin and tokenization quite frequently from some of the biggest companies out there, and I guess what more would you love to see on the regulatory front?
So the Clarity Act is another bill that's in Congress today, and I think that will help the markets understand, what is a commodity, what is a security, what are the registration processes, and how can the various ecosystem participants, what do they need to do to provide exposure to digital assets to the broader retail and institutional investor base.
And when we look at Bitcoin, Ethereum, Solana, do they often move in tandem with each other? And if you're an investor, do you want to be exposed to all three? Do you want to be concentrated in one?
So I don't know the latest correlations, but generally Bitcoin and Solana have a tighter correlation than Solana and Ethereum do.
All right, really interesting stuff. Nick, thank you so much. Appreciate it. We'll see what happens with the rest of these crypto moves, as it's often a volatile asset. Last week, we were just trading at record highs of Bitcoin. So you never know, but appreciate you joining us on set.
Thank you so much.
Bitcoin and Ethereum both sliding today. The pullback follows renewed tariff threats from President Trump that are rattling risk assets across the board. For more, we're going to bring in Maya Vujanovic, FG, Nexus CEO, Digital Assets. Maya, it's good to see you. So let's start big picture, Maya, because you look here, cryptocurrencies continue kind of losing ground. Bitcoin, Bloomberg noting if Ether actually risks lapsing into bear market territory. What do you chalk that up to? Is that macro worries, Maya? Is it folks just booking profit? What do you think?
Yeah, I think you're right. It's a combination of two. One, there's been a lot of OGs who've been in this market for a long time.
You've been in this market a long time.
Since 2010, Bitcoin. Yeah. But of course, I haven't held since 2010. I wish I did. But you're absolutely right. I think it's a combination of both. You've got macro, where tariffs are obviously, on one day Trump is going this direction, next day he's going on a different direction. So I think that is giving a bit of a risk-on sentiment to folks, certainly for me, right, where I'm not touching my crypto portfolio for a little bit. On the other hand, you've got a lot of people who've been in crypto for a long time and they're just deciding to cash out at the moment. So I do think it's a combination of both.
So you wouldn't be on these kind of stumbles here, Maya. You wouldn't be buying these dips, or you would?
I would be buying the dips.
You would?
I would. I would also be cost dollar averaging, which is exactly what institutions are doing with ETFs now, right? So I think this is where I say to folks, if you don't have money to lose, I think you should just sit back and maybe pick up an asset that you really believe in. But other than that, I think you should just wait a little bit.
What do you say about, there's been Bitcoin bulls on set in that very chair you're sitting in, who said, and I asked them why they believe in Bitcoin. And some of them say, why? Because it's digital gold. But I just wonder if some viewers are watching this now and they're kind of looking at all this and saying, well, why don't I just stick with plain old gold, which seems to be ripping here? Why not just stick with just tried and true yellow metal instead?
Yeah, Josh, I'm not going to give you the answer that everybody else tends to give you, which is this whole kind of, Bitcoin maybe maximalism. I'll just give you a perspective that I've been living in for the last number of years. And I've spent about 10 plus years in emerging markets. And I've also spent working across 5 different continents in the world. And reality is that before everybody was seeing kind of de-dollarization here in the US, I was seeing it about 15 years ago, where I saw China move into Africa and Latin America and starting to own mines and supply chains. And I saw people trying to move away kind of from the Western dependence. And so for me, when I got into Bitcoin because of technology and its ability to really, when you read the Bitcoin white paper, it says peer-to-peer. I got in because of tech, right? And I would have never assumed Bitcoin would be at 125, right? Or 122, or 112 today. And so I would tell you that I got in because it is a technology that really does enable peer-to-peer, right? And so, yes, you can own that digital bar of gold, but you can't really move it, right, in a sense, right? This is something you can carry everywhere you go. You can cash out, you can pay people with Bitcoin. And so it is a much more, it's easily transferable asset.
Let me ask you, in terms of near-term catalysts for that asset, do you look at the Fed and investors are betting a cut's coming? Is that a potential catalyst?
Yeah, absolutely. I think of Powell, just this morning, I wrote just a blog this morning
Concerned about the labor market?
Yes, and he basically says, hey, there isn't much liquidity in the market, right? And so if he cuts, absolutely. I mean, we're going to see a lot of retail come into AI, come into rare minerals, right? This has been a hot topic for the last week as well, and absolutely into crypto assets, because this asset class is not going away. It is only going to proliferate into tokenization and into stable coins further.
Do you have line of sight, Maya, into what we've been seeing in terms of ETF flows? Have they been stronger? Have they been weaker? And who's committing capital? Is it retail? Is it institution?
Yeah, they're kind of stable in the last week. That you haven't seen massive positive inflows on ETFs, but you potentially would, right? If there's a rate cut. If there isn't, if we keep on the same playing field as we have now, I don't think that we will see inflows in ETFs. People are on the sidelines at the moment, so I don't expect any massive inflows at the moment.
I once asked Mike Novogratz, I said, is the Bitcoin market going to be as big as the gold market? He said yes. In fact, he cut me off. He was so great. Yes, absolutely, done. Are you that optimistic and confident?
Yeah, love Mike, friends. I'm not sure.
Why? Why do you say that?
Because I think it's going to take a little bit longer until we get there, till we can really compare to gold. Now, some might say you're absolutely crazy, right? Bitcoin is going to overtake gold. Yeah, it will in the future, potentially, yes. Particularly if we see clear regulation, Clarity Act is in place, market structure bill is in place, right? We see tokenization coming. We see Ethereum kind of proliferating all over. We see Bitcoin adopted as a payments platform. Yeah, 100%. But I think until then, I'm still kind of more bullish on gold.
Let me ask you, I'll get you on this. Let's say, Maya, you're hanging out with friends and family down there in Miami, and they say, Maya, what should I invest in? Should it be Bitcoin or Ether? And I can only choose one. What would you tell them?
Tough question. I would say probably Ethereum, because it is a...
How come? Why you choose that one?
It's a yield-bearing infrastructure, right? It's a programmable money infrastructure. So Bitcoin is a digital gold, and Ethereum is actually useful. It is being used today, we like it or not, right? It is in infrastructure on Wall Street at the moment. Every largest institution on Wall Street is piloting on Ethereum. And so it is something that is going to be useful. And I don't know if you saw an announcement this morning of Larry Fink saying they're building their own tokenization platform. JP Morgan yesterday announced they're putting in 1.5 trillion into security assets, right? And AI and infrastructure, right? That is all going to be connected onto digital infrastructure. And I think I would bet on things that are going to be used when it comes to that.
Maya, great to see you. Great to have you on set. Thank you.
Thank you so much, Josh.
Bitcoin is rebounding today to some extent after Friday's steep losses. Have the jitters been shaken out, or should investors prepare for more turbulence in the sector? Joining me, Kavita Gupta, Delta Blockchain Fund founder and general partner. Good to see you, Kavita. And I want to talk about some of what you're investing in. But first, we got to talk about what happened Friday, which seems to have really been exacerbated by the leverage that people appear to be taking out to buy crypto, and that then all crumbles when you see a downside move like that. In your view, is that partly what happened, and what are the implications then for crypto going forward?
It's been a crazy market with $20 billion wiped out in liquidity on one day. And there has been a lot of conspiracy theories about what really happened. Of course, Binance said it has a technical glitch with some of the altcoins listed way below what it was in any other places, which made the liquidity really happen in the perp market with a huge response on Hyperliquid, a bad response with a over $30 billion liquidity playing in. Lot of different applications. It was like a complete house of cards going down with a lot of liquidations going from top to bottom. And that has taught us, or for a lot of people, it gave us flashes back to 2021 FTX Luna crash. But the only thing out here is market recovered very, very fast. Like ETH figured out above 4K again. You could see Solana going up again 13 to 15%. The blue chip tokens have definitely picked up. Doge did a really good turn back, but the altcoin has really washed down. And we're going to see some time before the altcoin rally going to happen again.
And do you think for most investors that the place to be is not necessarily in those altcoins, but more to stay in the more sort of established and liquid markets in crypto?
I think, Julie, that depends upon whether it is going to be institutional investors versus retail investors and the profile of your risk. If you're an institutional investor, you are anyways going Bitcoin, ETH, Solana, XRP, Doge, like bunch of those very blue chip tokens, which are doing very good recovery. But if you're a typical crypto trader or managing a liquid fund like us, which has a little bit more risk associated with it, you're going to still go with a very sound technical coins like EtherFi, Sei, Aptos, Sui. But yes, there has been a bigger wash over there, but we are expecting a bigger recovery just based on the technology and the team supported to it.
And Kavita, I'm curious kind of where we are in terms of the next technological wave within crypto, or even policy wave. You know, this year we have seen obviously a big sea change from Washington. We've seen stablecoins sort of take more institutional hold with the IPO of Circle as well. What should we be looking for next in terms of, you know, sort of the next phase of crypto?
When we think about technology, I mean, I would have said if it's just a trend, digital asset treasuries are already taking $1 trillion, $1 billion. And also one of the reasons that DATs like Tommy Lee's digital asset bought a lot of ETH at the low point. But if we are talking only about technology wave, I would say two big ones. The interoperable stablecoins are going to be a big technology, because if every technology company, if every bank is going to issue their own customer stablecoin, we're going to have a huge problem in the interoperability. The very similar thing which we saw when there are 1,000 different coins, different layer one blockchain like Solana, Ethereum, Arbitrum, Polygon, etc. came in. How do you do the interoperability and settlement? And then the second big one, which we are already seeing with Ondo and Athena slowly getting very big institutionalized, are the yield products. Today, when you have USD, you are expecting somewhere treasury rates of 2 to 3%, all the way up to some savings and different hedge fund products. But also with stable coins, you can easily go between 6% to 15% using decentralized finance. And that, I think, is going to be a huge institutional adoption product and going to change the way we see Wall Street or the banking financial system.
Kavita, we'll be tracking it all. Thanks so much.
We've had a bit of a roller coaster week on U.S.-China relations, with the clear signs today that things are, at least from Trump's rhetoric perspective, on the upswing. We've seen Trump in a couple different forums today, including just about an hour ago at the White House, offering really kind of optimistic commentary about where things stand with China, at least for today. For one, this off again, on again meeting with President Xi Jinping of China and South Korea is now apparently on again. Trump said just a little bit ago, it looks like it's going forward. He also raised the possibility of some sort of agreement when the two leaders gather. They're set to talk on the sidelines of a summit in South Korea at the end of this month. Treasury Secretary Scott Bessent also announced today that there's going to be a kind of a series of talks leading up to that meeting. The first one is going to be actually this evening here in Washington on the sidelines of the IMF annual meetings. And then there'll be a follow-up next week at about a week's time in Malaysia. This is between Bessent and China's vice premier, sort of the two top trade officials there. Overall message here is things are looking good, and it comes a week to the day after Trump kind of surprised markets to the downside with this idea of a 100% tariff, an additional 100% tariff on China over rare earth minerals and supply chains that China is looking to restrict there. Worth noting that Trump didn't take this 100% tariff off the table today. He even discussed moving it up ahead of the November one that he's promised. But the overall message you're hearing from Trump and Bessent, for today at least, is that things are looking on the upside. The relationship between Trump and Xi, they're confident at least, can kind of bring the sides together and at least maintain the status quo for the time being.
And Ben, while we have you, we know Vladimir Zelensky in Washington today with President Trump. You know, after Ben Trump's remarks, Russian oil exports, India yesterday, what did we learn today?
Yeah, we learned a bit today. So this meeting, as you mentioned, was Trump with the Ukrainian president talking about the war in Ukraine, with oil clearly a big element of it. As Trump has talked about this week, Trump claims that India is going to stop its purchases of Russian oil, which would then pressure an end to the war. If that goes forward, it's a very significant economic lever to use against Vladimir Putin and Russia because of how reliant Russia is on oil revenues. Trump reiterated that claim today. He talked about how India, in his view, has already de-escalated, even as Indian officials aren't going quite that far. There is evidence that Indian suppliers are buying a bit less Russian oil, and that's going to continue. But there's no promises from that side, at least, of zeroing out. But this is clearly a lever here. Zelensky was also talking about oil, talking about meeting with energy companies for infrastructure projects going forward. So there's a real tie-up here between the energy diplomacy, the tariff diplomacy, all these kind of things intertwined, as Indian officials are also in Washington this week, just to make things even more complex, with at the IMF meetings to talk trade as well with the Trump administration. They're trying to get a 25% tariff over Russian oil lifted, and clearly both sides are trying to kind of find a middle ground there.
I think the shutdown, Libby, I think it's day 17, Libby. So how much longer? I mean, is it a week? Is it a month? What are you telling clients? Lay out the scenarios for us.
Yeah, well, nice to be with you. I mean, I think just to your earlier point, this is actually the longest full government shutdown. The other longer shutdowns have been partial shutdowns. So this shutdown has already made history. The sort of apples to apples comparison was back in 2013, when the government was fully shut down for 16 days. And again, now we're going on the 17th day. I don't think there's really a real end in sight. I mean, this will depend, obviously, on both sides, but the pain tolerance for this shutdown is much higher than in previous shutdowns. Republicans very comfortable with their position, and so are Democrats. They are comfortable effectively not lending their vote to reopen the government in order to shine a spotlight on these ACA subsidies, these Obamacare subsidies that are expiring at the end of the year, with notifications going out in November. So they're betting that even though voters don't like shutdowns typically, that they will reward them for, again, bringing attention to this issue, which does poll very well. So long way of saying it doesn't look like the House will be back next week. So at a minimum, that means that we're looking at the end of the month. We're telling clients November, maybe even Thanksgiving. But again, one side can capitulate tomorrow, in which case the government will reopen. But that does not look like it is imminent, at least at this point.
Do you see, Libby, is there any kind of specific pain point that could be coming that would pressure this to end? Turmoil at the airports, SNAP benefits. Do you see anything like that on the horizon?
Yeah, I mean, I personally was sitting on the tarmac at Reagan National last night for 4 hours because of some of the disruptions at ATC. So I do think that as those disruptions are more widespread, and if you remember that back in 2018, 2019, when the government was shut down partially for 34 days, that was what ended up reopening the government. It was issues with the FAA and air traffic control. So certainly that could put pressure on lawmakers to reopen the government. One pain point could have been the fact that 1.3 million active military folks would have missed their payday 2 days ago, but the president and the administration reallocated some money at the Pentagon in order to pay those people. So that sort of minimized that potential pain point. But again, we're looking, I think, theoretically, at least, into November. That is when I think Democrats are hoping that these more attention comes on these ACA subsidies. That's because a lot of folks will be notified that their premiums are increasing. And so I think they believe holding out until then makes political sense. But again, it looks like there will be more disruptions, at least at the airports and elsewhere in the government, which will have, I think, from our perspective, could potentially have meaningful impact for the economy that may not be reversible, unlike what the market assumes at this point.
Well, I want to end there, Libby. What are the implications that we as investors need to think about here? The effects of all this on the economy, on sentiment, on the Fed. What should be on our radar?
Yeah, so I think that this is the sort of the issue. I think markets have, understandably been kind of shrugging this off, political dysfunction, what have you, any economic impact largely reversible. That I think is probably true. However, the longer the shutdown happens, and because this is a full shutdown, meaning it's impacting about 1.5 million workers who are either working and not getting paid or furloughed and not getting paid, you could see changes in their consumption behavior. One missed paycheck, maybe not that big of a deal, but continuous missed paychecks actually will make a difference in how these folks consume. And 80% of the federal workforce, remember, is outside of the DC, Maryland, Virginia area. So this is not just a kind of localized impact. This could be more broadly felt. Outside of just the GDP impact, and we estimate if this goes on until November, you could see a point shaved off. Again, some of that will be reinstated, but some of that could be just lost GDP activity. But in addition to that, for a market's perspective, we're not getting any data. And that, I think, is the big rub. Not only is the Bureau of Labor Statistics not releasing data, they're also not collecting data. And that could make the Fed's decision, come FOMC and end of October, that much more difficult. I mean, we assume they will cut then, but they are not going to be getting at least a complete picture of what is happening in the economy. The last thing I'll just say is, of course, our view is there's sort of a window of weakness in terms of economic growth here. There is labor market fragility, and this could just add a kind of another wobble, if you will, to that, to that kind of that weakness or that fragility.
As the U.S. government shutdown stretches into its 16th day, chances of it being resolved before the end of the month seem slim after a 9th failed vote in the Senate on a funding bill Wednesday. Here with more Yahoo Finance Washington correspondent Ben Worschel. Ben, there doesn't seem to be a lot of motivation at this point.
For sure, yeah. So we're 9 failed votes in the Senate so far. We're set for another vote in about an hour's time at 11 a.m. That's expected to have the same result, and then after a few more votes, the Senate is set to to head home for the weekend. So there's no kind of end in sight immediately on this shutdown. One tentative signal on talks that's worth tracking is Senate Majority Leader John Thune did reveal this morning that he's offered Democrats a date certain vote on this issue of Obamacare subsidies after the shutdown ends. That's a minor concession. It's not going to be enough for Democrats who want this to be happening all at the same time, but it is at least directionally a signal that talks could be in the offing there. Not this week, maybe next week, maybe weeks after that, but we're talking more and more about November as a timeline when the pressure on this heats up. The immediate question for the economy right now, I think, as markets largely have been ignoring this shutdown, is this question of Trump cutbacks, reductions in force, layoffs of government employees. We had a few developments there in the last 24 hours. Trump's budget chief talking about having thousands and thousands of layoffs as part of their overall goal here. Trump talking about cutting what he calls Democrat programs. We also had a ruling that paused these layoffs for now, although it's temporary. Trump is still going ahead, promising that before the end of the week, he's going to announce more layoffs, more cuts to programs. Whether that can go in force remains to be seen. But this is clearly going to be kind of the standoff is going to continue for at least a few more days, if not more weeks.
Feels that way. Ben, let's shift gears to foreign policy. President Trump also claiming yesterday that Indian Prime Minister Modi says that his country is going to stop importing Russian oil. Listen in.
He's assured me there will be no oil purchased from Russia. I don't know, maybe that's a breaking story. Can I say that? Would you say? There will be no oil. He's not buying his oil from Russia. It started. You know, he can't do it immediately. It's a little bit of a process, but the process is going to be over with soon.
Ben, I don't believe India itself has confirmed this yet. So what do we know about this?
Correct. We don't know a lot about this beyond this claim from Trump. I mean, this comes ahead of a highly anticipated meeting tomorrow in the Oval Office between President Trump and Ukrainian President Vladimir Zelensky, and a possible call between Trump and Vladimir Putin on this issue of the war in Ukraine. And this would be a major development in terms of pressuring Putin to end the war because of his reliance on Indian oil purchases. As you mentioned, what we don't have is confirmation. We don't even have confirmation that a call occurred between Trump and Narendra Modi of India in the last few days. The Indian Foreign Ministry had some comments this morning about diversifying energy sources, talked about increased energy cooperation in the United States, but notably did not confirm or deny any plans to go to zero Russian oil purchases. There is some evidence that Indian traders are looking to cut back. There's a Reuters report from New Delhi this morning about Indian traders lessening their purchases of Russian oil, but notably not at the behest of the Indian government. So even a small decline, even if it's not what Trump is promising of zeroing out and happening soon, would be significant as it would cut into Putin's efforts. I think the larger context way to understand this is tariffs. Indian officials are also reportedly in Washington this week to talk about tariffs. There's a 25% tariff on India over this issue of purchases of Russian oil. So I think there's a calculation happening here that maybe some declines of Russian oil purchases could lead to some declines of tariffs at that 25% tariff. Whether that works out, how much it goes down in each direction, very much clearly up in the air.
Ben, thanks for keeping track of it all for us, as always. Thank you.
Well, Americans are wondering if they'll be thankful for an end to the government shutdown this Thanksgiving. But for now, standoff still remains in place across party lines. Our Washington correspondent, Ben Worskell, joining us now with the very latest. Ben.
Hey, Josh. Yeah, this afternoon we did have some news on the shutdown from the court side of things. A lawsuit brought by unions that represent federal workers did offer a preliminary ruling that does put a pause on the layoffs or in government parlance, reductions in force that the Trump administration is seeking as part of the shutdown. It was a notably pointed ruling. One of the quotes was that the Trump administration has taken advantage of the lapse to assume that all bets are off. This isn't a final ruling. This is a preliminary ruling while this judge in California decides whether to make this permanent. But it does stop a kind of key pain point that we've been watching in this shutdown. Trump has been clearly using these threats of layoffs as well as the actual layoffs we've seen so far to pressure Democrats. So he doesn't have that on the table, but it comes as both sides remain really kind of staring at each other, locked in it. We had another vote this afternoon in the Senate, exactly the same margins, another failure to reach the 60-vote margin to pass the GOP plan, as both sides, or as Republicans at least say, they're not going to negotiate and Republicans are demanding. Overall, the kind of atmosphere here in Washington is of resignation that people should settle in for a long shutdown. I wrote today about how the word November keeps appearing both from lawmakers and from analysts as for sort of when we should watch for the end of this shutdown. That's because early pain points haven't proved as painful, and now a lot of those are shifting to the end of the month. Government or military workers or soldiers will continue to get paid until the end of the month for certain. Also, a lot of the healthcare deadlines are in early November as well. So a lot of people are sort of settling in for a shutdown that could last for a long time, especially as these rulings kind of lessen the pain in the short term, even as the economic costs build up over the longer term.
All right, keeping you busy. Ben, thank you, sir.
Sure thing.
The government shutdown is now in its 13th day, still with no end in sight, and the specter of a trade war between the U.S. and China reemerging after President Trump threatened to slap a 100% tariff on the world's second largest economy. That spooked Wall Street, as well as the world's central bankers. They are gathering in Washington this week for annual meetings. Here to discuss the potential risks faced by the U.S. and global economies, Lakshman Achuthan, Economic Cycle Research Institute co-founder here on set, and Robert Sockin, Citi senior global economist, joining us as well. Robert, let's start with you here. So, we have obviously sort of a confluence of events, if you will. The shutdown's still going on. The president may be reigniting tensions with China. But all of this has had curiously little economic effect this year. Does anything change in the last few days?
Yeah, these are great questions. And I think, in our outlook, we are seeing reasons to believe that the tariffs will bite more as we go forward, which is going to lead to a bit of a slowdown in U.S. growth and a bit of slowdown in global growth. It's been much slower to take hold because of a lot of distortions from the tariffs. Businesses and consumers have front-loaded activity to get ahead of them, and that's going to lead to some payback. Tariffs are pushing up consumer prices more, eating into income. So we do think that things are changing and the tariffs are going to start to bite more. And so all of these stresses of the government shutdown, escalation of the tariff war with China are coming at a difficult time when the data may be starting to be moving into a softer period. So I think this just puts some more downside risk. Now, that being said, I don't think the tensions with China are going to stay where they are. I think we're going to see a de-escalation. And I do think the government shutdown, when it ends, you'll see most of that activity made up, but it is putting a lot more risk into the system at a time when we already see the risks growing of a slowdown.
Lakshman, you've been relatively optimistic here on the economy, right? Does anything that has happened change that view?
To the contrary. When we were talking a few weeks ago, we were saying we were edging towards the Goldilocks situation, which is not too bad inflation and the economy getting a bit firmer. I think if anything, oddly enough, we're closer. Moving closer. Yeah, it's weird, isn't it?
Walk me through that.
What gives us that? Looking at forward-looking indicators of inflation first, they've been pretty benign. We will certainly get some pass-through from the tariffs biting, as we just heard. That'll be on the good side. But overall inflation, a lot of it's services and other parts of things that we buy, it's actually easing. That pace of inflation is easing. So the fear of an inflation spiral is just not here, at least for the next couple of quarters. And the Fed is looking at the jobs market slowing from the earlier slowdown we've been having. So I think Fed's pretty easy, regardless of the headlines. The fundamentals are making them pretty easy. And then when we look at forward indicators of growth, cyclical indicators, that's different than econometric models. And those cyclical indicators have firmed a bit in the United States. And also globally, when we look at industrial activity, we're seeing some firming. Maybe just it's slowed enough that there's some pent-up demand and it's starting to kick to the upside. So on a cyclical basis, that's pretty constructive, looking at a couple quarters. And then you had the market sitting there at pretty much as high as you, how high can you go, right?
Yeah.
And we get a little bump on, a little jitter on Friday around some of this tariff talking again. I don't see it really amounting to much here. I think those fundamentals, growth and inflation, are fairly benign.
And Robert, on this front as well, I was struck this morning by a new survey from the National Association for Business Economics, NABE, N-A-B-E as it's known, that showed that economists on average are raising their forecasts for growth this year. Inflation-adjusted GDP seen at 1.8%. It was 1.3% in June. Now, that's still not like amazing growth, right? It's still sub 2% growth, but it's still better growth than had been expected. So what has contributed to that? And do you agree with that forecast? And do you think that we're going to be able to keep up that pace?
Yeah, and these are all great points. As was just mentioned, we have not really seen that slowdown take hold yet that I talked about earlier. That the economy has been quite resilient through these stresses in the U.S. and abroad, and you've seen growth forecasts move up in tandem. And even though we have a slowdown coming in the fourth quarter, potentially maybe stretching into a bit of next year, it is a much smaller and less severe slowdown and shorter than we were expecting before. So I very much agree with the tone of these forecasts being moved higher. But I would still come back to some of the risks that I mentioned. They're still there. Very high tariffs, payback from that front loading of spending, more push up in consumer prices, that there's still a lot of risk in the system. And even though that we've moved to this narrative that things have looked quite good, so they'll continue to look quite good, there are still a lot of risks that persist. And at the same time, that these risks are ongoing. You're seeing, as I mentioned, new risks being put into the system. So I agree that the tone has been quite constructive. Things have been moving in quite a positive direction, but it's still a lot of things that are hard to interpret. The labor market was mentioned, just to add a point on that. Very hard to interpret those data. It certainly has the Fed worried that you've seen a sharp slowdown in job growth. At the same time, we're seeing a lot of changes in labor demand and labor supply that argue that job growth should be moving at a lower level than it has been in the past. So I just think that what we're seeing now is a very hard labor market and economy to interpret. And I'm still probably a bit more cautious than the average forecaster, given that I think the tariffs are playing through the system still, but they're playing through slowly.
And Lakshman, we started by talking about the shutdown. And most of the economists we've been talking to are saying, well, you get that sort of bounce back in growth when it's done, but it's not good if it goes on longer.
Sure.
And not only are we on the 13th day, but it doesn't seem like it's going to end on the 14th or the 15th or whatever.
Right.
So how does that factor in, if at all?
Well, I mean, as you say, it's a negative, and then you get a little bit of a bounce back around the event. I think in terms of business cycle dynamics, it's at this stage not really a big issue. It's not changing the direction of the cycle or the drivers of the economy. And those drivers of the economy, by the way, haven't changed. They've been the same for, 100 years, as long as we've had a market economy. And so watching those during periods of confusion can be extremely revealing.
What are we talking about?
For leading indicators, like the weekly leading index or the future inflation gauge, that's growth and inflation. Those give you directional calls in the middle of all this fog. And they're telling us edging towards Goldilocks. I mean, that's weird. It's not always the message you think you're going to get,
right,
but it is what it is, and I'm here to tell you.
Okay, I'm glad you are. Lakshman and Robert, thank you so much. Appreciate it.